Hello, I'm here with Jean Pisani-Ferry, who is the director of Bruegel and a former advisor to the French Finance Ministry.
Long ago.
Long ago. Thank you very much for joining us. A few years ago, we were speaking together at a conference in Amsterdam, and unfortunately then we were also talking about the European crisis. At the time, you made a very interesting comment to me. You might not remember, but you said, we were talking about the 1930s, and you said, unless you lived through something like this, you can't actually fully understand the political dynamics that often underlie bad economic decisions. And I think we came to the conclusion this problem could have been solved with 300 billion euros to Greece, but we agreed that it was politically impossible. And now we're looking at something which is maybe on the magnitude of 20 times as high as that.
I think the analogy with the 1930s is that we are seeing more and more the political dimension of things, becoming prominent. It was clear in the Italian election, where you had this vote basically dominated by the discussion about Europe. And then it was clear again in the Cyprus case, where you had this agreement on, whatever you think of the agreement of the 15th of March about taxing deposits, and that was rejected in Parliament. So the pattern we had seen where essentially it was governments on the one side and markets on the other side, and has been replaced by a pattern in which more and more public opinion, citizens are part of the game. This makes the whole game much more complex, much more difficult to manage. And it's interesting that, in fact, you saw, markets have become much more complacent. They barely reacted to the Cypriot issue. But citizens are much more present.
Because it seems to me that the problem is, in many respects, the minute you got the ECB to agree to backstop the bonds of these countries via the OMT program, the outright monetary transactions, you effectively addressed the systemic problem, it seems to me, because they are the issuer of the currency and they are the only credible backstop. The problem is that they are doing so with a high degree of conditionality, and that conditionality imposes more fiscal austerity, which exacerbates the other problem, which is a demand-side problem.
Well, we don't know yet, because the OMT hasn't been tested at all.
Not yet. It's been a grand bluff so far.
I mean, it was announced in July. I mean, it was announced, first in July and then in September with some more details. But then everybody expected the OMT to be activated in the case of Spain, but Spain did not apply. And Spain did not apply because they felt that they could benefit from the shadow of this announcement without having to go for a full program. So we don't know exactly what it would entail. I mean, it would entail some sort of agreement with the European Stability Mechanism, depending on the situation of the country, what would be the fiscal dimension of it, what would be the other dimension of it, we don't know yet. Obviously, there would be conditions. I mean, the conditionality is part of the European setup. So it's difficult to say actually exactly what it would imply.
And do you think that Cyprus has any implications? So the reason I ask is that, as you say, there was a deposit insurance guarantee. It was revoked, but ultimately uninsured depositors were affected. So if I'm, for example, an Italian deposit holder or a Spanish depositor, I might now think that the next time there is the threat of problems that we could have a Cyprus type of outcome there. Do you think that's a real risk?
Well, at the same time, the decision was reversed in the case of Cyprus. On the 15th of March, they decided to go for a taxation of all deposits, which actually made sense from the Cypriot point of view. Mm-hmm. Because from the Cypriot point of view, the small, quote-unquote, depositors are less mobile than the large ones. So the more you would tax the larger ones, the more there would be a risk of capital outflow, and then leaving the banks. Whereas the smaller one, they were less mobile. So actually, it made more or less sense from the Cypriot point of view. Now, it was sending the signal to the whole of the euro area that the 100,000 euros deposit guarantee. I mean, the guarantee for deposit below 100,000 euros was valid only to the extent the guarantor is itself solvent, in this case a Cypriot state, and that there was no common guarantee, in fact. So they reversed under pressure after the rejection by the Cypriot parliament. They reversed all that, and in fact they bailed in the large depositors. So the signal to the rest of the euro area is, in fact, at the end of the day, that they are protected. So I think from this perspective, it's not such a bad signal. Now, the other signal there is that there are capital controls.
Yeah.
So Cyprus introduced capital controls, and that's a big shock, because capital controls were not supposed to be part of the rules of the game in the euro area. So the risk is that anticipating that capital controls would take place in other countries, there would be preemptively capital outflows, or at least that some capital inflows that were returning to countries like Spain, etc., would not be returning because of this fear of capital controls.
And that is a new dynamic, and in fact, in some respects, it undermines the whole premise of a currency union, because the minute you introduce, it's almost like introducing capital controls in, say, one particular American state or Canadian province. In some respects, it potentially sets the stage for a breakup of the currency union.
Well, it's serious. True, it does not exist within the US or within any country, and it was not supposed to exist within the euro area. And also it could be interpreted by some as saying, there's all this liquidity provision by this European system of central banks, the euro system, to banks wherever they are, that has actually offset the capital outflows. There's been the capital outflows from Spain, from Greece, from Portugal. They have been offset by central bank liquidity. Now, if you introduce capital controls and you say capital controls can be part of the game, what if next time a country facing this kind of situation, you say, okay, let's introduce capital control instead of providing liquidity to offset completely the capital outflows? That would be the fragmentation, financial fragmentation of the euro area, not only, as we've seen, from a private side, but also from a policy side, because from a policy side, you would introduce those capital controls. So it's a very ambiguous and very, in my view, dangerous precedent.
I agree, because there must surely, for example, be the temptation to resort to that, for example, in Spain, because Spain was subject to very, very large, widespread capital outflows in the spring of last year. Of course, it's very hard to read. You had, in effect, a silent bank run, because unlike in most countries where you have traditional bank runs where they're lining up outside to take their deposits out, if you have a concern, if you're in Barcelona and you have a concern about, say, Banco Santander, you take your money out of Santander, you walk down the street and you put it into the Deutsche Bank account that's in Barcelona. So you don't pick up the same kind of capital outflows, even though the underlying banking system is quite fragile in that regard.
But what we saw, in fact, was a sort of balance of payment crisis inside the Eurozone, that all the capital coming into those countries actually flew out. So that's what we have seen, and it was a big surprise because, again, it was not supposed to happen. The template for monetary union was that every solvent agent would be financed, whatever happens to the country. That the country dimension would be completely irrelevant. So if you're a company, if you're a bank in whatever country, and if you're solvent, you're going to get access to finance, without limitations. Now, what we've seen is that, in fact, there is country dimension. That de facto, we've seen, almost or exactly like for emerging countries, sudden stops and capital outflows on a massive scale. The difference was that the Eurosystem was willing to provide all the liquidity required to keep banks, finance and to give them complete access to liquidity. So this was an automatic offsetting mechanism. This mechanism has worked so far. I mean, this not without concerns, but it has worked in this way. And that was all the controversy about the Target 2 system, which is a recording of all those flows within the Euro system of central bank, just show that the central bank have done the job. Now, again, capital controls would be a different way of dealing with the same thing. So the question is, are capital controls now part of the toolkit or not? I would think that in the case of Cyprus, it's understandable that they had to introduce them, but it should be very clear that it's an absolutely special case, and that capital controls are not part of the normal toolkit in a monetary union. Because if this were the case, I mean, it would make a joke of having a single currency, because you would have de facto different exchange rates.
Well, you do in one sense. You could argue that I'm sure that a Cypriot euro beyond 5,000 euros is actually a differential. I mean, to obey the controls, you're probably looking at something very different. But I wonder. This is a common refrain that Cyprus is a special case, and it's certainly the case that its banking system, as a percentage of banking assets as a percentage of GDP, are multiples higher. I mean, you're 700-800%. But it's not different in kind. I mean, this seems to be a problem throughout the European monetary union countries. All of the banking countries, the countries have banking systems. Even Germany have banking systems where banking assets are, say, 300 or 400% to GDP. And it strikes me that it's very hard to provide a credible deposit insurance guarantee without the explicit backing of the ECB, and we're not there yet.
Well, we're moving in principle towards banking union. I mean, that was the important decision made in June 2012. That the heads of state realized that the response brought so far through essentially fiscal discipline and the focus on reforms was not sufficient, and that there was a systemic component, that the monetary union without a banking union was inherently fragile. And so the response was to say, okay, let's bring in the banking union, which means in the first step, common supervision, and then at a later stage, common resolution and a fiscal backstop. Now, the first step, the common supervision, is being put in place. But it takes a little bit of time that the ECB,
Is that applying though for all banks, or is that just applying to the
It's applying more or less for all banks. I mean, it's a sort of two-level system. Smaller banks there is more responsibility of local supervisors, but under the responsibility of the ECB, and the larger banks are directly supervised by the ECB, are to be directly supervised by the ECB. So it makes it's a very important reform, and it should be in place more or less in a year's time. Now, it's only the first step. The second step is resolution, and that being discussed now. And third step, or together with the second actually, is to have a fiscal backstop. Because even with very good resolution mechanism, very effective resolution mechanism, you can't exclude the risk that at some point you have to involve some budgetary money, because bailing in the creditors has limits, and in some situations you have to commit budgetary money. And the question is where this budgetary money would come from. If it comes from an individual state, then you don't break the link between banks and sovereigns, so you still have this inherent fragility. If it comes from a common pool, then you break it. And so that's the big issue, I think, ahead of us. In principle, the commitment to banking unions means you have a sort of fiscal union, off-balance sheet fiscal union, let's put it this way, so that in case of need, you're going to tap into a common budgetary pool. It's not yet put in place, and there are some disagreements, and there are some people saying that they are reluctant to go all the way through a banking union understood in this way. It's
largely Germany, I think, that's creating the largest opposition right now.
Germany. I mean, it's Northern Europe. There is reluctance. Now, what is very understandable, if it's said that you want to separate out the legacy from the future. Countries understandably say, okay, we are not going to pay for the past mistakes of our partners. If there was lousy supervision, the state responsible for that supervision has to pay for it. So if Spain had lousy supervision of banks, it's for the Spanish Treasury to pay for it, and it's for the Spanish taxpayers to pay for it. Now, for the past. Now, for the future, it could be different. That's one thing. The question is, when you make the break, at what point you introduce really this shift of responsibility from the national treasury to the common responsibility. Logically, by the time the central bank takes over, the ECB takes over the supervision, everything should go together with it. So logically, it's at this point of time that there should be the fiscal responsibility should be shifted.
Well, as we know, logic doesn't always follow in the politics
No, exactly.
of the European Union.
Exactly.
But on that point, we'll leave it. But again, thank you very much for sharing your thoughts with us on these important issues.